Hello and welcome to Eastern Horizon. Just days before Christmas, the Bank of England narrowly in closely contested to cut the interest rate. The central bank nine-member Monetary Policy Committee on Thursday voted 5-4 to trim the benchmark rate by 23.7%. This is the fourth cut of the year. So today I am joined from London by Daniyal Waheed, a British economic landscape observer and King's College London graduate in philosophy, politics, and economics. Thank you very much, Daniel, for joining me.
Thank you, Malik, for having me on the show.
So, how you see that the 5-4, this is a very thin margin, how it will help especially to tackle the unemployment, and then especially how it will be impact on the mortgage and the other kind of the stuff that the British economy right now facing.
Yeah, as you heard 2 days ago, the Bank of England cut their rate from 25 BP down to 3.75%. It was a close call, 5-4 split. It's important to notice that split because it shows how tough it was and how bank calls it closer call, which means in future every other cut would be a tough choice to make. Looking at the unemployment, it's certainly on the surge. Has been highest since 2013, if you exclude the COVID period. So the growth and the job picture in this it's the picture is quite weak enough to justify some pressure should be let off. In the bank's own minutes, staff now expects zero growth in headline GDP in the last quarter of 2025, and the bank's business context described as a lackluster economy with firms holding back on hiring and investment. That combination, cooling inflation and weak activity, creates a window for a cut. This is also why Governor Bailey swung to cut. He's essentially saying inflation is coming down sooner, while the economy looks softer, but we can reduce and squeeze, but really carefully. Looking at the mortgages, well, there are certain different types of mortgages. There are tracker variable rate mortgage holders, fixed rate holders, and people who are remortgaging, refinancing soon. So the best and the quickest impact would be felt by people who are on tracker and variable rate mortgages, because if your mortgage rate moves in with the bank rate, for example, a tracker, your monthly payment can fall relatively quickly. According to the bank, the estimate being discussed is roughly £29 per month for a typical tracker borrower, and around 500,000 households are in that category. So, next to that, little, yeah.
Okay, so the bank has described the UK economy as lackluster with no growth expected this quarter and rising unemployment concern. So, how significant do you believe this pre Christmas rate cut will be in providing a boost to consumer spending, businesses, and overall growth?
In a very short term, I would say weeks rather than months. This is more about reducing strain than creating a boom. So, and the UK economy doesn't respond instantly to one rate cut because many households are on fixed rate mortgages and firms don't hire just because financing is slightly cheaper for 1 month. So what changes between now and next MPC decision on 5th February 2026 is likely to be confidence at the margin, because it reinforces the idea that the peak in the rates is behind us, which helps households and businesses to plan. There would be a cash flow relief for subset borrowers because some people will feel it quickly, but most will not. As I said earlier, tracker mortgages, variable mortgages holders, they will feel it more immediately than other categories of mortgage holders. There would be a softer downside risk. The bank is trying to stop weak growth and loosen job market from deteriorating further. My take for this period up to early February is therefore a weak winter economy. There will be a weak winter economy, but with slightly less headwind than before. Uh, because the bank itself is starting from a flat growth baseline for late 2025. So this cut is best understood as sport at the margin, not the dramatic stimulus. And well, we do have to look at the political side too. Politically, that nuisance matter because the government will understandably welcome any sign of easing pressure on households, while the opposition will argue that the cut is evidence the economy is weak. Both can be right in framing terms because rate cuts can be both relief and a signal of concern.
Do you think that this short term relief will make a way for some sort of the positive signals into the British economy? Because uh, how much chance that 2026 mean that the year would be more challenging, or it could be have some sort of the relief for the British people in context of this interest rate cut?
I would frame this as a central expectation with a range because MPC itself has signaled, as I said earlier, there was a quite closer call, 5-4. So MPC itself has signaled decisions will be more contested and more tougher next year. My take on this would be they can be one or two cuts more cuts in 2026 based on how the bank is talking and how several major forecasters are thinking. Two quarter point cuts in 2026 is a reasonable baseline, in my opinion, taking banks rate down towards 3.25% by mid to late 2026, which is quite closer to their optimal 2% interest rate, inflation rate. Uh, Reuters reporting cites forecasts consistent with two further cuts. Some forecasters like Deutsche Bank's UK economist points March and June will be the month where there might be more cuts, and ING also points to more cuts next year. So we can expect like 1 to 2 cuts in 2026. But the bank's own conscious suggests a range. One cut if wage and service sector inflation stays sticky or if inflation expected don't fall. Two cuts if inflation continues easing and labor market loosens gradually. More than two if the economy weakens sharply and inflation falls faster than expected. So the key data the MPC will focus on will be CPI, of course. It's still trending down. Wages and services prices, these show whether inflation is becoming built in domestically. The minutes emphasizes that the pay growth and service inflation have eased, but some forward-looking signals may be flattening. This is exactly what will decide whether cuts will continue or not.
Thank you very much, Daniel, for joining and for your mean that the deep analysis on this British bank cut rate. Thank you very much for joining me.
Welcome, Alik. Thank you again for having me on the show.